We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
I see some of the comments coming in. You guys are funny. Is Apple going to die? All right, guys. So today's been a pretty good day for me. I hope it's been a good day for you guys. Today's sort of like my weekend because I take my weekends at an abnormal rate to the average person. I usually choose about 1 or 2 days between the weekdays to kind of take time off, and I usually work on the weekends. Usually, I find that actually a little bit better because I get, I think, more stuff done recreationally. I still do recreational stuff on the weekends, but recreationally, it's actually quite interesting to have a weekend on the weekdays, in my opinion. But anyways, hope you guys are having a great day as always. And we have some topics. They're in the title. I think I put them in the description as well. And that's not going to confine the conversation. You guys sort of also guide the conversation, but I have some quite entertaining stuff for some of you guys. I know that the Capital Mindset audience, for the most part, is a bit more, I guess you could say, further along in their investment journey than most groups. And we'll be discussing something that's quite unfortunate, but also kind of also like financial junk food. At least that's how I see it. And I know many of you are quite familiar with what I'm about to discuss, but we'll kind of push that towards the middle of today's discussion. And just for everyone to know, this is the public portion of the live stream content I'm going to be doing today. We are also going to have the ICOM later tonight with the other analysts, and we're going to be discussing a whole slew of different companies that we're really interested in pertaining to data centers. So we're going to be going over that. I won't be discussing too much of that here, but pertaining more to the hyperscalers, we'll be kind of delving into that, some cybersecurity potentially. I had a question I saw on Snowflake. We'll get into their earnings report. Oracle reported earnings today. We'll talk about that because that pertains to AWS and the competitive advantage that AWS is actually showing there. But let's get through it. All right, let me see. Oh, we did. Okay, so who buys TikTok? Well, I know why you're saying that. We'll start with that, actually. So if you guys didn't know, news came out, an article or several articles came out about last week. The Biden administration is campaigning off of banning TikTok. And this is kind of showing me that the larger governmental apparatus of the United States views TikTok and its Chinese, let's call it owners, as a security threat. And what's likely going to happen is something along the lines that, TikTok is going to be pushed into being like a forced sale, forced liquidation. So that is perhaps, I think, the most likely outcome. We could end up seeing something like a ban, but I don't think we have something to point to and say that's how things are handled. The closest thing I think we have to government coming in and sort of taking private assets is, of course, the situation with Russia, with the oligarchs. They took their assets from them. But I can't seem to point to, historically speaking, a social media platform. So getting quite specific, that's quite popular among a population just being banned in the United States at the very least. Okay, so for anyone also, I see that we had a question, how do I sign up for memberships? You can check in the description below. There should be the link to get into the club. And we have about 650 club members as of, I think I checked yesterday. So we've been growing quite a bit, actually, and I'm very proud of that. And thank you all the members out there for being part of that. So anyways, let's get into, I still think WD is doomed. Sven's recent videos may be oversimplistic. He typically has oversimplistic videos. And you know what, David? I will talk to you guys before we get into Amazon. Like I said, you guys drive the conversation. I have the baseline set up, but you guys drive the conversation. So I had a conversation with club members this weekend, actually, just about Warner Brothers Discovery. And so there are other club members who are already invested and have their thesis laid out. And a lot of their thesis, I listened to it and drew inspiration to kind of draw my own conclusions. Basically, in summary, I'm agreeing with them on a lot of this. Let's talk about the debt, for example. Right now, they have about $40 billion in debt. The cash flow seemed to support that debt. They've actually proven to the investor base, and in my opinion, that they are capable of paying down that debt or at least maintaining themselves. So the leverage levels are adequate, in my opinion. And when you look at the debt stack breakdown, a lot of it is due past 2028, which I don't think is at severe risk of refinancing at higher rates. Now, if we do see rates come down quite a bit, then I do think at that point we're going to see, let's call it a re-rate of Warner Brothers Discovery stock to the upside, because right now I think that is the main concern of investors. If you actually look at the content that they're putting out, it's quite good. If you guys haven't seen Dune 2, I highly recommend that movie. It's a good movie, and you should watch Dune 1 if you haven't seen Dune 1. But if you actually look at Warner Brothers Discovery strategy now, I actually look at it as a positive, not a negative, that they're licensing out the content. My largest investment in streaming being Netflix, and it's quite a large investment in my own portfolio. If you guys are curious about the thesis, I don't make new videos because I don't like pumping out the same old video like other channels do. But I have a video that from 2022 going over the Netflix thesis and why it was a good buy. Okay. Hindsight is 2020. So obviously you can look at it now, but back in the day, I laid out the ideas there, and you can kind of measure back and say, was I right or was I wrong, etc. So if you look at Netflix right now, you can actually watch Dune 1 on the platform. Warner Brothers Discovery is licensing out that content. And this is, I view it as a positive, because if you already have the, let's call it input costs on a particular content, and you're still able to monetize it past the, let's call it film life cycle in the theaters, I view that as a positive. I view Warner Brothers Discovery accepting the licensing model back as something that could be attractive or accretive to the business overall over the longer term. I don't think the market took it that way, and I could just be wrong here. That's also a possibility. I could be wrong that the market is rightly so concerned that Warner Bros. Discovery seemingly, sort of like as a view of weakness, has to license it out. That's another way to look at this, and that they don't get enough eyeballs on their platform. Because if you actually look at the subscriber growth on Max, it's not been too attractive, and they've been hanging their coat, and that's their fault, by the way, because they've been telling us to kind of focus on that KPI. Look at our subscribers on HBO Max. Same thing with Disney Plus. When we saw the lackluster growth in their platforms, that disappointed the investor base. And so Netflix has been killing it. Warner Brothers Discovery and Disney on that department has not been killing it. And so the clear winner right now of the streaming wars is Netflix and YouTube, if you count them. But really, when we're talking about professionally made content, Netflix is the winner there. So their forward, let's call it content life cycle or content pipeline, I think is also quite interesting. They have the Harry Potter show coming out. I'm skeptical on how the Rohan movie is going to be. If you didn't know, they're making more Lord of the Rings content. But the video game component of the business, I also think they have quite a bit of IP to make video games off of, and there could be some profitable endeavors there. And really, at the end of the day, it's the debt concern and how much can they get or grow direct to consumer. But I don't view the direct to consumer as the end all be all. So Warner Bros. Discovery actually does look attractive. My valuation measures, so not to bear the lead, was roughly at an attractive point around the $8.50, which we were just there last week. And I have a range. So I'm actually still within that range of where I think it'd be interesting to add a position. If I end up deciding to add a position, you'll see it in the portfolio updates. But that is my opinion. I've just laid it out, and hopefully that helps out with your investigations or journey. But that's just my opinion. Okay, so Zillow, please. We can talk about Zillow. Is Warner Bros. Discovery a buy? In my opinion, the price point now looks attractive. I don't know if I'm going to end up executing a position on it. I always get back to, I already have Disney, and it's done well. I already have Netflix, and it's done very well. Do I need another media company? Now, Warner Bros. Discovery has seemingly not gone through the same, let's call it, appreciation cycle that Netflix got from the market and Disney then got from the market. While Netflix executed phenomenally on all fronts, Disney is sort of going through that transition. They're a little bit further along, and the debt concern isn't really there. And then Warner Brothers Discovery is still has to sort of prove itself. And so it might be just the timing aspect of it all. Okay, so let's, I can talk about Zillow, but I'll put a pin on this because I do want to get into AWS, Oracle. So Oracle reported earnings today. And with Oracle's report, they did show pretty strong growth. I think it was like mid 20 percentile growth. And right now it's for the past decade, it's been really good to be a hyperscaler. So you have the top players, which you have AWS, then you have Azure, and then Google Cloud, and then you have Oracle, and then you have IBM. Really, among those players, you do have across them all, it's an attractive business. Even when you had Big Blue trying to say that they were a competitive player, the reason why they were doing that, and the previous CEO was saying that, is because, of course, the cloud business, if you can be one of the top players, there's a lot of money to be made here. It's a very good business to be involved in. You're basically going to be the toll road of the internet, and for a lot of these businesses to build their businesses on top of. And so AWS, if you actually looked at, for example, Amazon's cash flows, a ton of those cash flows came from Amazon Web Services, and Amazon Web Services was able to support the investments in various other businesses. So Oracle, my issue with Oracle, and there's several, it's not really from a technological standpoint, it's actually from a financial standpoint. So if you actually take a look at Oracle's balance sheet, they have a tremendous amount of debt when compared to their peers. And when I say their peers, I'm including all the hyperscalers. So that's, again, Google, Amazon, Microsoft, if you want to throw IBM, but just focus on the top ones. And for now, for the time being, Meta is not a provider of cloud services. That could change at some point in the future. Who really knows? And that's not in my thesis on Meta. So I have no plans on adding to Meta based off of that. So I'm actually going to pull up the recent quarterly report from actually, we can just take a look at the no, that was released December. So I'm going to go just to their website. Let me pull up their document, and we can go over the filing. Did they not release it yet? Current report filing. Yeah, they didn't release the. We have total revenues in this. Revenues. Here we go. Okay, I pulled up the recent 8K, and then they have their balance sheet here. All right, where are you guys at? You guys are here. Let's present the screen. And all right, let me see. Should be okay. Let's zoom in a little bit more. Okay, so if we take a look at the balance sheet here, let's scroll down to non-current liabilities. What you can see here immediately, what should stick out, is $82 billion. Now, it is coming down, but when you look at their peers, they have, let's call it, to be kind of, say it in a crude way, they're handicapped when compared to some of their peers like Alphabet, which has over $100 billion in net cash. If you want to throw Meta, but we're not discussing Meta. And even if you look at Amazon, Amazon has a huge war chest, not as big as Alphabet's, but a huge war chest, and the cash flows to support it. And then again, you look at Microsoft. I don't think I need to tell you guys that Microsoft also has a war chest and a tremendous amount of cash flow. So when you're looking at the next, let's call it, iteration or investment cycle, the companies that have basically more money than anyone else to spend on that new infrastructure is going to be those larger players. And so Oracle is typically playing catch up here. And this is a consequence of their investment strategy. So Oracle, for the most part, has been focusing a lot on share buybacks utilizing debt. And so this sort of financial engineering puts the company in a weaker footprint or weaker stance for the future. And so I have had no interest in investing in Oracle, even though my portfolio is really heavily tilting towards hyperscaler investments and has been for a long time. But when I look at the landscape, I view Oracle as just being the weakest potential player. So they're the worst house in a, well, not the worst house. IBM would be the worst house, but they were one of the worst houses in a fantastic neighborhood. So you would have done well, but I feel like you would have done better, and you would have done better in other investments in that same neighborhood. And so it's not that on an absolute terms, it was a terrible investment, but there were other ways to play the hyperscaler investment without kind of getting into, let's say, something like Oracle. So comparing it to the alternatives, I didn't view Oracle as that interesting of an opportunity, although it is in isolation a decent business, a good business. Yes. I do not understand the desire from retail investors to want to get into the next Tesla. And there's always, and I've been kind of tweeting about this recently, the not frustration, but it's sort of like, guys, come on, don't try to chase the next blank, right? And so, like, for example, they say Sentinel-1 is the next CrowdStrike. They say whatever of these electric car companies, Lucid or whatever, is the next Tesla. Tesla is Tesla, and that's not an endorsement of Tesla stock, but Tesla is Tesla. And the desire to kind of catch up because someone missed out on the prior investment leads us to make bad investment decisions more often than not. And the car business in particular is a bad business. It's a tough business. It's a very high capex intensive business. And you find yourself more often than not in a highly competitive environment where your investment's life cycle is in and of itself can be quite risky. And your customer base is, well, depending on if you get into financing or not, you're taking on alternative risks. Tesla, for example, has decided not to take on that risk, and they use partners like Wells Fargo to finance their cars. But if you look at most auto manufacturers, they have a financing arm, so they've tried to juice their returns or juice their income by taking on additional risk, basically becoming a bank and taking on financial risk, counterparty risk, and the like. So it is not that normal. So Warner Brothers Discovery has crazy debt because of the AT&T spinoff. So AT&T had a crazy amount of debt, and they decided to just pack on some of that debt into Warner Brothers Discovery. So Warner Brothers Discovery had a bad starting setup, and that's the issue that's plagued them. Yes, exactly. I agree with this. Lucas, automotive in general is just generally super hard. And so there are other businesses that are, I think, a better setup or better, let's call it, the business model itself isn't as challenged. And with automotive, the business model itself is quite challenging. And so in and of itself, you have to be successful within a very difficult landscape, while there's other, let's call it, businesses over here let's call it, I don't know, in the software space that the economies of scale are a little bit better. Or, even some boring business that you might find out there, some industrials where there are probably maybe one or two other players and the margins are a little bit more predictable. There's consumer staples, which is probably one of the most predictable types of businesses you can really project out into the future. And, there's a premium applied to that because of the Amazon of China, and I'm in. Yes, the classic whatever of China. Okay. The Amazon of blank and the meta moment. Yes, this has also been bugging me because of the PayPal commentary on the meta moment. Whatever blank, the meta moment. There was a new one that was like, oh, it's Google. It's gonna have its meta moment. It's like, well, Google meta moment will, wake me up when it's like $60-ish. How are you feeling about AWS's weakness to Azure, relative weakness to Azure? Well, this is a great comment or question. And I know that AWS right now, that's now Amazon's next focal point. So Amazon is switching its eyes, and the current CEO of Amazon, he actually was a CEO of AWS. And right now, Amazon's strategic shift is going to be from focusing on the retail segment to now coming back and focusing on AWS, because they haven't ignored Azure's recent relative strength. So I'm going to have to see what Amazon's plans are. All I know is that they are moving in that direction now. And we're going to have to kind of wait a couple quarters to kind of them to pencil out what their game plan is. And I feel as though with Amazon's historical, let's call it, achievements in the cloud space, I want to give them a chance. It could be that Azure does one day overtake AWS, which would be insane and good for Microsoft, and kind of Microsoft proving that it's the best company in the entire world and justifying its multiple. But I want to see what AWS really comes out with, because now they're going to, I think they did a really great job and surpassed my expectations on retail. I want to see what management's able to do when they're focusing now back at AWS and relying or stabilizing growth was their commentary. Stabilizing growth, improving margins going forward. But the stabilizing the growth part is where I kind of want to see what their game plan is there. By the way, if you guys haven't seen, answer the polling question, and we're going to get into that. That'll be the middle segment as we kind of close off Amazon. And so the commentary on Amazon, because we haven't talked about Amazon just yet, is I think with Amazon, it's rallied a bit, and we have a lot of significant unrealized gains in the company. But with Amazon's thesis, there are a lot of things that, for example, myself had not panned out for, and that's what I just said, retail. So club members can go to the original write-up I did on Amazon back in Q4 of 2022. And part of it was kind of saying how Amazon's plan to shift to a lot of third-party sales is going to help drive the retail segment. Now, what I didn't plan on and what I was kind of penciling out for retail is that they were going to break even, and the ads business plus AWS was really going to drive a majority of the profits. Now, what I didn't plan for is sort of happening, and retail is actually becoming part of or let's call it's having positive contribution margin to the underlying net income. So going forward, and also one thing that also I didn't plan for was Amazon being able to monetize their infrastructure investments in a way that kind of also gets them back in ROI. While I did complain in the write-up about their overinvestment in infrastructure, and then they course corrected. Now management showed me that, well, they're also quite resourceful and adaptive to whatever challenges at hand. And, honestly, they've justified their paychecks, and they were able to figure out ways to further monetize the infrastructure. So now they have these new services that Amazon is basically making money from off of all that infrastructure they built that was a UPS and a FedEx basically inside of the business. And part of the thesis, again, was that the CapEx cycle was going to end, and you could reason out that they weren't going to continuously build a UPS and a FedEx inside of the business. And at some point that's going to stop. And it did. And now you're starting to see tremendous amount of cash flow production. Okay. So dividends, we're going to be discussing dividends in a second. Can Snowflake survive with big tech? So Snowflake by itself was what I called a poor setup stock. So while Amazon was a pretty good setup, and I'll discuss what that means, because just saying that, what does that mean? We'll get into that. So Amazon going forward, I think, has a lot of tailwinds in front of it. I think, again, the ads business is going to continue to grow. We're going to see what they start to do and pivot with AWS, if they start to improve that. Because if they improve that meaningfully, then again, there's going to be a tremendous more amount of cash flows to be had, on top of the fact that the ads business is going to pick up really strongly in the next decade. So I view Amazon's current price as sort of fair to slightly undervalued. It's not the opportunity it was before. And so I'm continually to add Amazon, but just at smaller increments than I was before, not as heavy as I once was. Now, Snowflake, where do they come in? So Snowflake reported earnings, and really the stock fell on guidance. But this is a company that I like to point out that I did say had a poor setup. What does that mean? When I say a poor setup company, is it's priced for certain events. It's priced for perfection. A company, another one that comes to mind that I did talk to club members about back in the day was Hershey's, HSY. They were also a poor setup. So basically, when you have an earnings multiple that implies a certain story playing out, a very easy concept to understand. If you're implying a certain reality and that reality doesn't come to fruition, or let's call it, you're basically saying with Snowflake at the multiple that it was, that everything has to they just have to nail it. Every single piece of the story, they have to nail it. And so any little chink in that armor, bad guidance, then, here you go. You have a really strong sell-off. And I would say still at this price, it's still on the expensive side. If you look at the cash flows that they're producing, a lot of that cash flow is supported by SBC. So a lot of the expenses that they're generating is stock-based compensation. And on top of that, you had a management change, which is just drawing in some uncertainty. So when you have a story that was basically priced for perfection, and you have any questionable, let's call it chinks in that armor, bumps on the road, and management change, that's a change in leadership, that's a change in strategy or potential change in strategy. Well, now you have a conundrum in front of you. Now you have something that it's an unknown. And what was the story before? Well, now you don't. It's lesser known how that story is going to play out. So Snowflake, I personally think it's too expensive, even at these prices. I haven't really delved too deep into evaluation, but I kind of was able to rule it out just on how much I had to expect for growth or forward growth in this business. And frankly, this is actually kind of sad, because I think when Databricks goes public, they're going to be trading at a similar multiple. And so the opportunity isn't going to be there. It's going to be priced out. That opportunity is going to be priced out. And in a world where you are competing with AWS, Microsoft, because they also have products that compete with Snowflake. I think that I don't know enough detail about Snowflake's differentiation in their product base to make the justification to invest in someone like Snowflake, because then I have to really know the story. So when the story's priced for perfection, I better know every detail of that story down to, let's call it the microscopic sentence or periods, every period within that story. And I don't. So it goes into the too hard bucket, because from a financial perspective, it's too pricey. It's too much involved there. And then from the technical perspective, I don't have that. So I can't pretend to say that I have the full story figured out. So I have no margin of safety. I have no edge here whatsoever. And so I have to bow out when I'm looking at Snowflake. It's just not for me, as kind of like a funny way to say it. Okay, so by the way, if you guys are liking this live stream, feel free to like it. If you're watching this on another platform, you can like the tweet. You can also retweet it if you so wish. But if you guys are enjoying it, feel free to let me know. You can also comment afterwards, and that also kind of lets me know that you liked it. Okay, so say more good snow stuff. The stickiness of their business model across all of the data silos, they are quite sticky. So once they acquire a customer, the dollar net retention rate is quite high. So that is a positive. And they are still expected to continue to grow because the whole sector, the whole pie is growing. So everyone is growing because the entire world is moving in this direction. The entire world is moving into a more data dependent direction. So anything and everything involved in that space is going to do well. Again, so that's the good thing. That's where you have a good house in a good neighborhood. That's kind of what you're looking at with Snowflake. The question is, is that whole neighborhood, some of these houses, what's the relative valuation compared to these other houses? So I know that the business is good, just looking at some internal return metrics, but I don't know necessarily if the price that I'm being offered for this house in this good neighborhood is attractive. So, okay, what do you think of cloud security like Datadog? Well, I don't think cloud security, and I think Datadog, I think, data analytics, and I think Datadog, or data aggregation tools, and I think Datadog, something that a data scientist would use. I think, when I think of cybersecurity, Palo Alto, Zscaler, CrowdStrike, Fortinet, etc. But Datadog, best of breed in what they do, and they're priced for it. Let's take a look at their share price real quick before we get into the high dividend strategy stuff. And so Datadog was talked about by one of our analysts in the club, and it's actually done really well since he pitched it. A shout out to Leo. But anyways, looking at Datadog's price performance, if you look at, well, let's zoom out because I want to show you 2021. You kind of look at the exuberant, let's call it crackhead prices, and then the sell-off back into, again, 2022 where it bottomed, and the performance, let me see since then, because that's going to be my comparative analysis. So it's done about 89%, which is good, but there's been plenty of investment that's done better. Within the SaaS business, in their space, the other company, trying to remember, they're almost irrelevant now because they got acquired by Cisco. I forget their ticker all the time and their name. I don't know why. But anyways, they're the best of breed in what they do. Their competitor was nowhere near as good, and their competitor was always playing catch up. And Datadog was cloud native, meaning that they came off the ground running, working on the cloud. And so their implementation was a lot smoother, and their competitor was still in a license platform or a license model on top of being an inferior product. Splunk, thank you, Stone Cold Investor. Splunk. So Splunk, just like when they look at their competitor Datadog, they were, okay, how can we kind of emulate Datadog? And you were basically, if you were buying Splunk, you were investing in the player that's like, what am I doing? How do I copy the best player? I'm not the best. I want to copy the best. And so, it was very fascinating to watch Kathy Wood go into Splunk. Very fascinating. She really does know what she's doing. So with Splunk, you had a business that was in transition to license from to SaaS, software as a service, and Datadog was already there as a software as a service cloud native solution. And on top of that, had a better product when you look at, for example, what data scientists prefer to use, Datadog. So of them, you know, you have other businesses in the B2B software solutions. I am personally invested in Salesforce. That's kind of my go-to. And Salesforce finally declared a dividend. By the way, did you guys know I'm now a dividend growth investor? I'm officially a dividend growth investor. It's a thing now because we have Salesforce declares a dividend. Now we have Meta doing a dividend. So the majority of my portfolio is officially a dividend portfolio. So I'm a dividend growth investor. Suck on that, strong man. Because I see you in chat. Suck on that. All right. Anyways. $23 billion buyout. Yeah, no, it's bought out. And, you know, I learned from Stone Cold Investor, who he is far more familiar with this stuff than I am. And I found it funny because he told me the joke, what people in his network feel about Cisco acquisitions. So they like a product and then Cisco buys it. Enough said. The product's great, then Cisco buys it. And now it's not good. So, okay. Let's get into the topic that's in the middle of the title. So the central topic. I have found what I believe to be I'll be nice, the silliest YouTube finance investment product ever. Okay. Like nothing I have ever seen out there beats this. This is relatively new. So you have older, let's call it strategies in this space. And you know, there's a lot of silly stuff out here on YouTube. There's a lot of really bad stuff. Like there's really bad stuff. But this pretty much takes the cake. Because if I walk you through, I know that my audience, you guys are going to catch that nearly immediately. And by the way, if you guys are liking this live stream, feel free again to leave a like. I got to do the reminder. So we have, you know, newer people coming in, etc. But if you guys like the content, feel free to subscribe and stuff. Okay, so I have it in the thumbnail, and you guys might be seeing in the thumbnail, Yield Max and Defiance. These are the companies, right? It's not the strategy, but these are the companies that are producing these products. And these products are designed to do one thing. The products are marketed towards, you know, income-oriented investors. And we all know, okay, the nuances of dividends, right? Because we have in the YouTube space, let's call it in the YouTube iceberg of YouTube finance, you have, you know, the people who are clown stock investors, right? We call them that, or whatever. We have the dividend investors. And then I think within the dividend investors, we have a couple branches within that family, and they all don't like each other. But we have the dividend growth investors. We have, maybe you could say, the middle of the ground, just higher yield dividend investors. And then there's the guys that are saying, hold my beer, that's not high yield. This is high yield. And those are the ones we're going to be talking about today. So the strategy in question is called the options long or selling call strategy, right? Another way to say it is, you know, there's different variations or different branches of this, you know, like the wheel strategy, etc. But for the most part, there's products out there that exist to provide you an income, and they provide you an income in the form of selling you or a strategy that relies on options trading, primarily selling calls. And we won't get into, I think I'll make a video on synthetic versus non-synthetic. So for the most part, we're just going to be talking about the overall strategy, which is, again, selling calls to produce an income and what that entails. And different people out there in the ether are promoting this, but they all have one thing in common. Typically, what you find with the proponents of the strategy is they're of a more unfortunate economic upbringing. I'm trying to be, you know, just dancing around. I'm being very corporate with my language. I'm learning how to be more corporate, but more unfortunate upbringing. And a lot of times they parrot the same kind of necessity for success in this strategy. They want to retire tomorrow, or they want to retire very soon. They don't want to work too much more into the future. They just want to retire very soon. And so these products, I'll pull up a popular one. Let's start with where it started and how it is now. So one of the ones that is fairly popular, let me see, it's QYLD, I believe. Yes, QYLD. We're going to look at one of the older ones. I'll just use this one right here, QYLD. Okay, because we're going to start we're going to start in the beginning. Okay. So this is one of the oldest products that exists that follows the strategy. And with QYLD, you're getting now roughly an 11.51% dividend, give or take, right now. And it pays monthly. So even better because you're looking for income. So it's something that pays monthly. Wow, amazing. So again, these products are more or less marketed and targeted for someone who wants income. But when we break it down, the product itself, I don't even see a necessity or for its existence, because you're basically saying, I'm going to guarantee that you do not achieve alpha. And so the whole point of a product is that you achieve some form of desired performance. And I think all of you who are watching, for the most part, you guys all know that if you're not beating brain dead investing, you are just wasting your time. That's the truth. You're wasting your time. What is brain dead investing? Well, brain dead investing is investing in the index, VTI, VT, VU, whatever your heart desires, as long as you're really talking about low cost, broad based index fund strategies. This is a brain dead form of investing. There's nothing wrong with it. But if you're not beating that, you are wasting your time. And so everything else is, in my opinion, a complete and utter distraction. Total return is everything that matters, because if you focus on total return, income will follow. Income is just a natural consequence. If your portfolio grows as a natural consequence of your wealth growing via your portfolio, your income will grow. And on top of that, it increases the optionality later down the line if you so wish to diversify into different things that produce a little bit more income, like preferred stock, and then you're looking for lower risk. So these products are very fascinating because, again, it's a fund manager that's saying there's a product here, I'm guaranteeing you will not have alpha. And a lot of these other products, for example, these directional movement ETFs, like they're meant to be trading products, and they tell you in the prospectus. And even, with these products, you actually look at the prospectus, they do outlay the risks, of the NAV erosion, et cetera. But when we get down to even the ones that I'm going to be discussing, this is like non-degenerate. Okay. So, and that's how scary this is, because the people investing in this, they're people who are less fortunate than most people, and they're investing in these stuff. And this is the least degenerate product out there, one of the least degenerate. So when we're looking at this product, and actually let's look at it from a total return point of view. And I'll use Seeking Alpha for this. Don't worry, I'll have this up in a second. Just give me a little bit. Okay, so I'm gonna pull this up over here, and let me zoom in before I get you guys over here. Okay, so we take a look at this product here, and we look at it from a 3-year point of view. Wow, this is including dividends. So this is including the dividends that you've received throughout the time period. And you can see the performance difference between that and, again, a more or less brain dead investing strategy. And I think, what we should add? We should add the other indexes, because why not? So we'll add VTI, and we'll even add VT here. So we'll have everything pretty much represented across the big 3 funds. And as we can see, it has underperformed every single strategy, including dividends, or every single one of these brain dead investing products. And depending on what your focus is, if you want just total return, total world, you take VT. If you're still focusing on the United States, VTI and S&P 500, you can plug in VU or SPLG, whatever you want. But basically, these are the 3 big ones that are represented here. And so QYLD right over there, older one, severely underperformed. Now we're going to take a look at some of these other ones, and that's let me find the Defiance ones. And this one, yes, right here. So we're going to take a look, for example, at another pretty degenerate one. Now we're getting a little bit higher in the degeneracy scale. Okay, so, and then we're going to finish off with really degenerate. And then we're going to look at some creators and kind of who are the voice, let's call it paragons of this movement. And I can make tons of videos on these people. It's actually quite sad. And again, they are getting a lot of older folks, a lot of poorer folks into these products. And I'm not, okay, so a lot of people might have these misconceptions about me that, I'm, a Tesla driving. I don't drive a Tesla as my primary car anymore, by the way. But as like I'm a Tesla driving, government loving guy, right? I'm actually not. In fact, I'm very, I'm not going to get political, but I'm very skeptical usually of government involvement in things. This is actually a rare time where I'm almost like government should really consider looking at these products and who's getting into them and who they're targeting and think about banning them. Okay. Just a personal opinion, but likely, and it takes a lot for me to say that. So I don't like to, conclude that. This is one of those rare moments. Okay. So we're going to look at another one, QQQY stock. So this is the Defiance NASDAQ 100 Enhanced Options Income ETF. We're going to first look at it, just on a simple isolated chart. Oh, we forgot one Q. So this is a mockery of the NASDAQ 100, a complete mockery of it. And again, the whole purpose is, dividends and income. We're going to get into, again, the mechanics of it, which is insane. Yes. Yeah. Oh, thank you for the shout out, Cake or Steak. Yeah. If you guys are liking this content, feel free to leave a like. I see that we have a lot of people watching us live, wherever you're watching us from, YouTube, Twitter, Twitch, wherever you guys are enjoying us from, feel free to like, subscribe, whatever you like to do. Okay, Fabio being defiant on Defiance. Yes. Okay, so this is looking at it from inception. It is down 17.88%, but that doesn't tell us the full picture because, of course, you have to look at the total return component. By the way, the total return component gets a lot worse, especially when you consider taxes. So we take it from the what? Let's go 9/14/2023. So we're going to do it from 9/14/2023, but we're not going to compare it to the S&P 500. Actually, you know what? We are going to compare it to the S&P 500. And then we're going to compare it to the underlying, which is the Invesco QQQ Trust ETF as a decent comparison there. And let's go from 9/14/2023. We're going to switch over before we go there to performance total return because we want to look at the total return component. And again, I know that you guys, it makes a lot of sense, but I promise you, the people investing in this product, it will not translate well. It will not translate well. There's been times where I've had discussions with these people. It just doesn't go through. In fact, they actually tend to resort to offensive vernacular when they address your ideas, and they get angry if you question it. And again, you got to understand when you talk to people like this, they're looking at it from a perspective that they need this to work, which is a very unfortunate situation to be in. And honestly, I don't almost know how to relate to people who are in those situations. I'm sorry, I just don't. I think most people watching my channel also kind of don't. Because if you are someone who is watching video content on investing, you probably have disposable income. You probably are a bit well off compared to the average person, or at least a bit more interested in topics that might lead to you being more well off than the average person. And you have a different kind of mindset. Okay, so if I look at this product here, and I look at since inception, we take the total return. We see QQQY 9.10%, S&P 500 13. I threw in the S&P 500 in there again, just to kind of give you a broad market investing strategy, just to throw it in there. And then the underlying, the QQQ. So you buy this product, you pay the fund manager for the privilege of underperforming, and then on top of that, by the way, guys, I am not counting in the net return the taxes that you're incurring to get to this level. So the performance is actually worse. So you are basically buying a product or paying for a product, paying for the privilege of underperforming. So you're choosing poverty. You're choosing underperformance. And by the way, this is the funny part. This is during a bull market. All right. So this is during a time period where the market's actually in your favor. If you just go long beta at the end of 2022, brain dead, just long beta, you have done well. You actively are choosing a product that, despite a favorable environment, is producing subpar returns. So again, I know my audience, I'm basically preaching to the choir. You guys are just listening to me and you're like, yep, that makes sense. Yep, that's stupid. Yep, I get it. Trust me. And that's why I said when I found this on YouTube, I was shocked that there's a whole massive audience out there that looks at this and goes, yep, that's what I want. Yep, I want income. Yep. And then they come up with these very interesting sort of mental narratives, right? I'm going to take the income here and I'm going to use that income to then buy a good asset. And that's how I'm going to rationalize this. I'm buying this, I get the income, and then I buy the QQQ. And then, because you tell them, this is usually a reflection that they tell you when you tell them, why don't you just buy like the underlying? Why don't you just buy QQQ? No, I'll buy it with the income I make from this. And then you might be thinking, I know you guys are thinking this, why don't you just buy it to begin with? Okay, and we're going to get to the really interesting stuff because it gets way more interesting than this, okay? Like when we get into the yield max funds, there's what does the CEO or whatever her name is of Defiance, they use a term. So there's the thematic ETFs, like, semiconductors and all that jazz. There's the 5G ETF that they have, right? Those are fine, right? Because they're trying to capture, an idea. And if I look at their weightings, like for example, cybersecurity ETFs. Shout out to Dan if you're in the audience, because I'm not looking at this other screen, so I have no idea what the comments, because we're just getting on topic. We're not going to get into questions yet. Shout out to Dan if you're out there. You talked about cybersecurity ETFs, and you also commented on this too, that the makeup of cybersecurity ETFs, there's not really many of them out there, and they're quite interesting, right? Sentinel One is the top holding, so there's not really market cap weighted based cybersecurity ETFs, which is like, But okay, we have these different products out there, and we can have a discussion about the makeup of how they're targeting their underlying, let's call it, theme. But then you have the stock specific funds that are income oriented. Now let's talk about some, because this is for whatever reason like a rationale that people have. Okay, so I think I've beaten the dead horse here, but let's talk about Coney. Oh God, this one's funny. So this one is used as sort of like a champion, and we're gonna remove the S&P 500. This is used like as a champion of how these funds do it well, how these funds do it really well. Because look, I'm taking out total return, and we're looking at simply from a price return. So the fact that it's positive is going to be used, and often is used, as a rationale for how these things can do well. And of course, you guys are thinking what I'm thinking, right? And it's like, well, it's done well because the underlying has done well when we're going to talk about coin. And so let's look at it from this chart, because I think this chart looks a little bit nicer. So coin stock. And so you can see, okay, you zoom out from Coinbase and it hasn't done well. But remember, we're going to look at it from the inception of this fund here. And we're going to do just the comparison here. So we're going to put in coin here. And we're going to put them together. And I'm going to start it again. Well, just here's a zoomed out visualization. So you can see when they start. And you can also see they start typically, all these funds, they just pump them out when the underlying stock that they're about to release the fund on is doing rather well, or it's increasing in popularity, because their goal is to get AUM. So this fund has done quite well, and because the underlying has done quite well. But now we're going to go from the inception date. So inception date, 8/16/2023. By the way, trust me, you guys are going to find it real entertaining when I show you some of these creators, because it's, oh my God. It's ridiculous. All right. What was it? 8/23/2023. Okay. So, all right. So from a price return, I can almost tell you don't even really need to look at the total return. But even when we include the total return, Coney has done 117% and Coin has done 229.93%. And the delta is going to likely to increase. So the way I can kind of put this in an analogy, and I might do a video just on this with a little bit more fleshed out analogy, is you are getting an asset, and I'm going to make an arbitrage deal with you. Okay, so you're going to give me $100,000. I'm going to go buy this asset, and instead, I'm going to refrain from using the options example, because this is more or less mechanically what's happening to you when you're doing this strategy. And when you're doing the strategy non-discriminatorily, because the truth is, investing, especially investing in options, is hard. It's actually hard, guys, by the way. And so doing it algorithmically, or just like, okay, every single month I have to do like an options trade, that's a bad position to be in. That's a bad setup to begin with, because now you're forcing yourself to open yourself up to mistakes, and mistakes are going to happen, and you're going to probably get your butt kicked. But let's take, you give me $100,000. I'm going to go buy asset A. Asset A is going to go up 100% in price. But what I'm going to do is I'm going to take the 100%. I'm going to take 50%, pocket it for myself, instead of just, let's call it, that's what you're losing out on. I'm going to pocket it myself in this example. And then from that 50% gain, I'm going to give you some of that back to you. I'm going to give you some of that. And so that 50% gain that you've experienced, let's say I give you back 25%. And so you're going to look at it and say, wow, this is great. I made, 25%. I made 25% in capital appreciation. And you're completely ignoring the delta in your performance from the 50% total gain versus the 100% gain you missed out on. And let's say in this example, I keep the 50%. So to kind of imply some malicious intent there. Now, this is a little bit different, the nuance here, because they're not pocketing the difference, but you're missing out on the difference because you're giving it to someone else because you're doing an option strategy. You're just giving away the return to someone else. And so this difference in performance, what you missed out on from the underlying, you're earning only from a lower base. So you've been basically, in other words, having that asset decay from under you. You're losing out on that asset underneath you. And it's similar to that example I just gave you. So it's like an arbitrage that we're setting up. You give me $100,000, I go buy an asset, and I'm representing you. It goes up 100%. I'm going to take 50% for me. And then of that 50%, I'm going to give you as a dividend 25%. So it's still coming from your gain. And then that remainder 25% is your real capital appreciation. And so you're going to see I made 50%. I'm going to see, and you can change the numbers. You just use the numbers that we have in front of you. Let's say I buy an asset, it goes up 229%. And then, I take about roughly half, because that's roughly the underperformance, roughly half. And from that, you're going to get your dividends and plus your capital appreciation. And so you're going to say, wow, great, I made 117%. And I'm going to say, yeah, cool for you, man. Happy for you. When you're basically taking on the same exact risk that the person who just bought Coinbase did. You're taking on the same risk. So another point that people make, Yes. Yeah, and the monkey outperformed VT. Yep, you're talking about the randomness study. Yep. Let me go through some of the comments real quick before we continue, because I did see a bunch of comments come in. Yield max Tesla drives me nuts. Oh, buddy, we're going to talk about that. You're better off buying an index fund and just selling small for time. Yes, no. This has been repeated ad nauseum to the fans of these products. There's nothing we can do. VU and QQQ are about 45% overlap on a weighted basis, and they're still pretty different from a diversification standpoint when looking at the sector weights. Absolutely, yes, absolutely. And the monkey outperformed VT. Man. Oh, it was a diss on VT. It was a diss on VT. All right. But anyways, so the other argument can be sometimes used that during a downturn, these products are going to go down less because you're getting the income. So that's actually said. I'll give an example of a product, but first of all, that's not true. We already established on an upside standpoint, you're giving up a ton of upside. So you're taking on the same risk. So that's what I need everyone. If you're watching this, and maybe if some of your relatives are reaching out to you, they're typically going to follow the framework of they're on the older side of things, et cetera. For some reason, they get really attracted to these things. So send them this section of the live stream. Okay. But you're taking on the same effort and risk of buying the underlying, right? I'm buying Coinbase. I'm buying Coney, right? You're taking on the same risk. You went through the same effort. You are choosing to make less money, but you're taking on the same risk. That doesn't make sense in finance. That makes no sense. In fact, if you have a conversation with the fund manager, I would probably push the conversation consistently to what is your purpose? What value are you providing? What are you doing for the underlying investor? What are you doing? We made a product. Okay, what did your product do? We made a product that makes income. All right, and then if you're financially inclined, you're like, okay, what's your return? Are you following the return of that product? Are you saying you're going to make more return in the product? No. What's your point? What's your purpose of existing? Well, more than likely, maybe, I don't know, it's like a bottom fishing kind of strategy to just trying to make money, as much money as possible for the fund managers, potentially. Yeah. So yeah, you look at a strategy like Coney, and you get into that discussion about, okay, well, I'm taking on that same risk, like I just said, and I'm choosing to make less money, but I'm taking on the same risk. So let's take a look at one that for some reason these people who are fans of this are quite allergic to listen to. I do not know why they get angry when you bring this up. And that's actually a common theme for them, by the way. So, oh, wrong one, TSLA. All right, so we bring this up. We go to a chart right here, and we're going to start it around, all right, so 11/25, 2022, and 11/25, 2022. And of course, we're going to do total return. But first, let's begin from a price perspective. Or sorry, it's already on total return. So on price perspective, it's worse than this. But total return perspective, you see that it's actually gone down more than Tesla. So you've taken on more risk. And so this kind of goes to show you. And the upside, by the way, like we just discussed, it's capped. It's never going to match Tesla because you're giving up upside. We're doing the example of you're giving me $100,000. I'm grabbing your money. I'm going to buy the asset. And then I'll just give you, I'm making up a number here, but it's you. The point is there's always going to be a delta, and the delta can be quite large. I'm going to give you or some portion of the half of the amount that you would have made on the underlying. I'm going to keep it. In the actual example, what you're doing is basically giving it to some random Joe that you don't know. You have no idea who you're giving it up to, but you're giving it up to the market. Let's just say, yeah, you're giving it up to the market forces. You're just saying, no, I don't want that return. Here, take it. I'm going to take only half of that return, and I'm going to get a fancy dividend, and I'm going to feel rich. In fact, but you're just actually poor. That's the problem. so it's way worse than what you actually realize. And then on top of that, you're going to give your cut to Uncle Sam. It's going to happen. But anyways, so when we're looking at this, it should dispel the misconception that during a downturn, you're somehow protected anyway. Again, I asked, you should ask this question to the fund managers. What is your purpose? Why does this product exist? What are you doing? They're going to answer to provide income, blah, 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 blah. Okay. Doesn't make too much sense to me. I don't think it makes sense to the audience here. Okay. So BB up 10% today. And then there's the other component where we did, well, I'll say it is undervalued depending on how we look at it. But anyways, high key predatory. It is high key predatory because again, you look at the people that get involved with these products, they all follow nearly the same framework. It's typically targeting lower income folks. So, okay, I think I've talked about this a little bit ad nauseum. Now we're going to get into the fun side. So I think I found the epitome. There's a bunch of creators, but I found the epitome of silliness on YouTube when it comes to these creators. And I guess we're going to get into clown market conversation. Is the clown market back? I think nuanced, depending on where you're looking, depending on how you view it. Yes, it's back. But in some pockets, it's not back necessarily. And that's always the case. But overall, I'd probably say we're back, baby. Yeah, we're back. Looking at all the clown tokens, yeah, we're definitely back. Okay, so I found a creator, and thanks to you guys in the club, I found this creator. Otherwise, I would never know this person existed. And this person, my God. All right, I don't even know if you guys are ready for this. Some of you know who this is, but I have no idea if you guys are even ready for this. And this is something special. This guy's really special. All right, so let me stop sharing screen or present new screen. And crayon. Yeah, it's really bad. It's really bad. Okay. Let me make sure I share the right screen. You guys ready? Man, I don't know if you guys are ready for this. Like, I literally don't know if you guys are ready for this. All right, so this is the guy. This guy is yeah. This guy is something special. All right, so I'm gonna just play the very beginning past this.
So I don't know how to read this. If you know how to read this, that's great. This is my total value of my, it's called, in Charles Schwab.
So just want to play that part because I thought it was funny when one of you sent me the clip. I was like, I don't know how to read this because this is a very easy page to read. And so again, this is one of the individuals who actually is a huge proponent. He's not the biggest. There's one guy that's actually much bigger than him. There's a couple that are decently sized actually. So he's not the biggest, but he's by far, I think, the most entertaining to watch. And I say entertaining like he's financial junk food. Okay, so looking at the screen, we're going to read this together. And I think most of you can look at this and read it yourselves, but he doesn't know how to read it. So your account has lost $10,113 from December 29, 2022 to March 10th, 2024. Let me express to you how bad that is. Okay, let me just like, you can't even fathom how bad that is. Okay, if you guys didn't know this, back in December of 2022, November 2022 was the bottom of the most recent bear market. Okay, that was the bottom. Okay, so I don't know, like when I say you could have thrown a rock and made positive return, I'm not joking. You could have grabbed a rock and just thrown it into like I don't know, there's like a field of papers that all had stocks. Or maybe we did a hat. Maybe we did the hat game, and like I put a bunch of tickers in the hat, and then we just like shuffle it, and then you pick from the hat. You probably would have done well more often than not. Now, let me be a little bit more detailed with that response, because if you were anything outside of, let's call it tech, or ETF based or index based, if you were in mid caps, which for the most part, retail doesn't really even get into mid caps is really underinvested right now. But if you did like retail stock, let me be more specific, because if you're like a newer investor, you did like retail stocks. Yeah. If you did an index. Yeah. And so he has the indexes on the right hand side. And it compares his returns. And you can see by the color distinction, his portfolio, he names it in Charles Schwab as FIRE. So for those of you who use Charles Schwab, this is a very familiar page to you. Like I said, I think it takes skill during a bull market like we've had to underperform. Not underperform, sorry, to have a negative return. It's easy to underperform. Actually, most people underperform. The vast majority of people investing will underperform over a long period of time. But I'm saying to achieve a negative return during a bull run is a feat in and of itself. Okay. Like I said, any of the people we've ever criticized on YouTube, besides Paul. So Paul from Everything Money, he actually takes the cake. He makes this guy, and that says something. So like Paul is worse off because Paul is Paul. But all the other people that we've levied criticism against, say whatever you want about them, right? At the very least, they are long beta, right? And during a bull run, they have positive returns. Some of them beat, some of them don't beat, but they have positive return, because during a bull market, it's probably the easiest time for anyone to generate plus 1% return, just lowballing it there. So looking at this, I don't understand what this person is doing or planning on doing. And I've been sent a lot of clips from this individual, again, just like memeing it, financial entertainment, etc. And this person is a person that's like choosing poverty. It's like you're making the choice that you have. So like you have something in front of you. Like I have brain dead option investing over here, and then I have over here just like, I'm just going to be worse. I'm going to go for that because whatever explanation, I want income, et cetera, blah, blah, blah. Now let's get into the conversation on taxes, because taxes is something, for whatever reason, this individual thinks is not a problem. It's not an issue. It's how you pay to play. You pay to play the game. Oh, sorry. Before I forget. Yes, when we're reading this, we need to understand also the use of margin. This individual is using nearly 100% margin of their account. So, by the way, let's kind of do the calculation. I think we can do the calculation more or less in our heads. So, later, right here, he shows, okay, we have on the right-hand side the return. And by the way, like I said, the Russell has actually done poorly, and most of the return has come from the top stocks in the index. But like, again, the Russell, like I said, it's tough to do bad. The Russell's underperformed. That's why I added the nuance prior in my conversation. I said like, well, there are some small caps that have done pretty poorly, but the Russell has actually done, it's positive. it's positive by 19% since this beginning of his investment portfolio. Because again, he literally started at the bottom. Like, sorry to be repetitive, but you need to understand, if you're watching this, you're part of his community, like, you need to wake up. You need to understand. You have achieved something that is very difficult to achieve. You have achieved a negative return during a bull run. You have achieved a negative return, not underperforming the market. Again, it's very easy to underperform. I can accept, like, you know, you got 10%, 15% return, market return 30%, maybe you got 25%. And so that's good on isolation, but in the grand scheme of things, it's a poor return, or it's an underperformance. I can understand that. That's very easy for it to happen. It's hard to get a negative return during a bull run. That is hard. Okay. That is not easy to do. That is difficult. You have had to gone out of your way to get a negative return, right? I almost think, like, you know, it's like the guy who takes the SAT, the guy who got into Harvard way back in the day. It could be a fake story or whatever, but the analogy is what's important. He got a purposeful 0 on the SAT. So he had to be so intelligent and so, you know, direct to get a 0 on the SAT. And so Harvard accepted him, because that's how insane he had to be. That I'm almost thinking like that's what he did. Like he's just that intelligent. He's that insane that he's like, no, it's a bull market. I will find a way to make a negative return. I will find a way. I'm just like, all right, man, Harvard graduate right there. But anyways, so you kind of do your own calculation. I'll let you guys do it at home, because I do have to head out here in not too long. I don't want to. Oh yeah, hop on, Andrew. Hop on. Let me actually go ahead and send this to you, because we can't stay on for too long because we have to go to the private stream. Okay. Let me go ahead and send this over to my boy. All right, it's already sent to you. But anyways, that is the crux of the issue, all right? That this strategy is a choice to make less money. It is a choice. And here we have Andrew. All right, Andrew, take it away. Give your take.
My take on this?
Yeah.
I feel like I'm a lot less charitable than you are. I think the people that do this know that this is unsustainable, and they're lazy and just like want to hope that this is their way out of I think this is the final bad decision in a string of bad decisions that people have made. So for example, you don't save for retirement. Like, even the people in this Discord will say this. They'll say, like, if I was rich, I wouldn't do this. It's like, yeah, like, how many guys have said that? Like, oh yeah, like, if I just had like millions of dollars, I'd just be in VOO and not do this. It's because they know, like, I made a string of bad decisions. This is my last chance at maybe getting out. So I'm going to suspend disbelief and just hope that this works. That's what it is. And that's why I don't think logic will ever apply to this, because they've already broken logic. They've already said, like, this doesn't make sense, but it's like my last shot out of here. At that point, I don't think logic is ever going to win. So,
and I just want to say this, McBuddha T, you are, I didn't even think of that. It's actually worse than how I put it. You got a negative return in a bull market going long.
I mean,
my God.
It's funny because, like, for me, it's like not even like, I know you guys find it fascinating. To me, it's just kind of like, I just see it as like I see it as something akin to people going all in on options plays and like hoping they hit a winner, or people going, you know, all in on like some like tiny little crypto coin and just hoping that they can, you know, sell to someone else.
Yeah.
To me, it's not that novel. I just think it's a different flavor of the same. Maybe it's your first time like running into into like this, where like, yes. I guarantee you logic will not work. The only thing that will eventually have them realize is when they go, oh shoot, my account's now at 30,000. The dividends from Yield Max won't sustain my life. I have to pay the tax man $10,000 from last year. Oh, this really didn't work.
Yes.
And then they're going to blame the system. So.
Yep. Like, you're right. This is frankly the first time I've encountered in individuals who have that mindset. I've never been around people like that. So it was sort of like a reality shock to me that there are people who do think that way. And what I found more often than not within that group is like they are all really similar to one another, more than they even think, in terms of their own situations. And I now know and understand and accept, like I'm sort of on your camp, that they will not understand. It's not a possibility. And genuinely, they think that they're rich or on their way to becoming rich, and they are currently poor. They're going to remain poor, and that's like their destiny. Because I mean, it's a choice that they're electing to do. There's nothing we can do about it.
Yeah, no. Like I said, they're at a point where this is their only. They see this as their only way out for not having this is a person. You have $120,000 in your retirement account and you're 68 and you're like, I'm staring down the barrel of working the rest of my life. I will never get to a point where I can retire.
Yep.
And then you're like, this is my way out. That's all it is.
Okay. Regarding your question, what is your question, Michael Anthony? We'll answer your question.
I think he's saying why. I think he's asking who this guy is.
Michael. Okay, so if you watched earlier in the stream, I think it would make sense with the context of early in the stream. I did play what he said at the very beginning, and he said he didn't know how to read the documents in front of him or the page in front of him. That's, by the way, this is meant to be user friendly. So that's like the funny thing. So there are other files that your broker can provide you that are not as user friendly. Hey, shout out to you, Andrew, who complain about certain brokerages documentation, because it's actually really shitty sometimes. But when you're looking at this part of any broker, they're designed to be easy to read. And so, I mean, I think it's straightforward for the most part. Like, it says verbatim at the very top. So when someone says like, I don't know how to read this, well, at the very top, we can start by reading. Your account has lost 10,000 from December 29, 2022. And again, why I say the date is important, et cetera, and why we're talking about this is like, it is a true skill. But anyways, this is a good question, right? Okay, what are our takes on other ETFs like JEPI, SFAL, Maxi? Completely unnecessary strategies. Completely unnecessary strategies. They exist. Their existence for me is questionable.
Isn't SFAL like a short on the VIX?
Yeah.
So that these are different than, okay, so they're completely different then. Okay.
So you're looking at instruments that I question their necessity in the investing world. And again, I think that what you risk is wasting your time on products that are going to hamper your total potential wealth. And so, bedrock understanding of finance. Investing should be simplified to the point of, if you are, figuring out what do I invest in a cloud market or not, that's kind of the crux of the final discussion point. Cloud market or not, the successful strategy is buy the index. Keep buying the index. No matter what happens, buy that index. Choose an index. Stick to a strategy. VU, VTI, VT, pick one. As long as I feel like you're going to do fairly well, you're going to do better than the average person if you do that. And then if you want to do individual stocks, you need to understand it's going to take work. It's not that easy. With all of these people that are buying the Yield Max funds that are, and by the way, the Yield Max CEO, I didn't get into this because the Yield Max CEO himself says that you must reinvest a good portion of the dividends that we provide to you. And that's how you avoid the NAV decay. And so when you actualize the rate of return, you find that it's not that impressive. And then when you look at the funds that have specifically done well, they are only doing well because the underlying is doing well. And you're always held with the same question: why the heck am I not just buying the underlying? I'm doing all the same work. It's like Andrew comes to me and says, or no, it's like, imagine I did this during November of 2022. You guys remember the audience who's been with me for a while. You guys remember what it was like Q4 of 2022. Meta is down really low. Everyone hates on it. Imagine if I did all that work and said, I think Meta is undervalued. And then I choose to buy a product that will somewhat follow Meta and achieve way less return than Meta, just so I can feel fancy that I'm getting a check in my brokerage. And so my total return is down. So I'm getting basically, and this is what Elemental, tried to say in his conversation that I found hilarious, right? Was you're basically getting money from your own portfolio back to you. It's like that example. It's like as if I gave my money to Andrew. Andrew went and bought Meta, and then he's going to keep half of the returns. Half of the returns he's just going to keep from me, which is 200%. So he gets 200% return from my investment. And then from the rest, 200%, he's going to give me 100% in dividends. And then I'm going to have 100% in capital appreciation, 100% in dividends. And now I feel really cool because I got 200% return. But I'm not paying attention to the fact that I could have had 400% return. And so and in the reality, it's not that the fund manager keeps that return. You're giving it up to the market. You don't know who's taking it from you. It's going away, but you don't know who's getting it. But you are giving it away. It's crazy.
No, I mean, well, it's really interesting because the analogy that he used in specifically for real estate, I think is extremely like, it's actually exactly how he thinks about stocks. And it just shows how he even kind of understands this is a stupid investment, but he hasn't come around to emotionally accepting that. I don't know if you heard his comments on real estate.
Oh, no.
Okay.
Yeah.
So he said, if you own a house, if you're in your primary residence, you care about it being nice. You want to keep things nice. You want to keep it because it'll appreciate and you'll sell it. But if you own a house that you're just renting, you don't care about it staying nice because you just want to have cash flow from it. So you don't care if it goes to shit. All you care about is, do I get my rental income from it? That's his approach to yield max. And if we think through this house situation, right, what happens? Your house goes to shit and you try to sell your house and it goes below market value. That's yield max.
Yeah. Wait, I got an email right when you said, did you say about maintaining the house, like putting maintenance into the house?
He's saying you don't care about maintaining your rental. You only care about maintaining because you care about maintaining your primary residence because you live there and eventually you'll sell it.
I don't care what he says. That's someone who's never owned real estate, rental property.
Oh, for sure. Yeah, and then he's saying your rental, you don't care. All you care about is the monthly cash flow. Yeah. You don't care about maintaining it, about putting anything into it because the only thing that matters is cash flow. So like you can let that house go to shit. And my point is, and Lucas, I also now have a rental and we definitely have conversations about keeping that because it's still your asset that you want to appreciate. Like you're not sitting here like, oh yeah, let the thing, we'll have it decrease in value. I mean,
Lucas doesn't know what he's talking about. He needs to just enjoy the income. Yeah.
Right. So the point is, but it's interesting because I think that's a perfect analogy for what yield max is. It's as if you have a rental real estate. You don't do any maintenance into it. You just let it go to shit and you lose money on it because it goes this dilapidated building.
Yep. And when we have another bear market, which will happen, all the audience of Capital Mindset, they genuinely know this. Like, again, the audience that we've cultivated in Capital Mindset is, again, typically more, I guess, further along, usually in their investing journeys. And so when we get into these topics, they're fairly okay. They're up to speed with it. But it's a fairly novel, let's say, understanding that bear markets happen. They happen. We don't know when, but they happen. The very next bear market, so many of these people, they're going to get, that's when they get that awakening.
Not even a bear market, just a flat market.
Okay, yeah, just a flat market too. But a bear market, that's when they get, I think, slapped or clapped. But
and a bear market's going to come the year they have to also pay $10,000 in taxes. Mm-hmm. So then it's like, oh, now I have a bear market. Now I can't sell anything. But speaking of which, this bull market after one of the earnings calls today I was listening to on the way home might continue from one of the hyperscalers.
Oracle?
Yeah.
Yeah, I just looked at Oracle's earnings. We're going to talk about it in the club stream.
Yeah,
definitely.
It's interesting.
We have some questions here that we'll address, and then we'll start to close off. So what are your thoughts on SCHD? A lot of people say to accumulate this for many years for retirement, for dividend growth play. Is that legit? I think it's way more legit than this.
This is my take. If the fund isn't completely crap, like let's say roughly, even if this underperforms the S&P 500 by 2%, like I know compounded is a lot of money. If your savings rate is good, this will be fine. Like, focus on that. Focus on having a job that pays you well, that you don't have to be like optimizing this perfectly. SCHG is fine. I think it's based off the Dow Jones dividend.
Yes. I'll say it this way in another way. If your psychology, and if you're honest with yourself, your psychology is that it's a necessity for you to focus on a dividend growth strategy, I'm not going to shame you for it. Do it. It's going to keep you at least invested. Will it be the best scenario for you? Probably not, but it keeps you invested. And that I think is more important than anything. Savings rate is probably the primary success factor for investing, for like a successful retirement. Savings rate's number one. And then number two is the component of return. So if you don't optimize perfectly the savings rate, the return component, but you optimize the savings rate, I think that person's going to be fine. And a strategy like SCHD will do fine. Will it do the best? Probably not. Could you have done better with the brain dead approach of, broad-based index funds? Probably, potentially. But are you going to risk it all? Definitely not. Definitely not. Just do not fall. And my one commentary to you is do not fall for the classical trap of I will buy when it's going up, and then when it's going down, it's bad, and I don't want to buy, and then you're going to change strategies too much, and you're going to be inefficient, tax inefficiency. You're going to make a lot more mistakes than you otherwise would have. You're going to regret that. But
I'd also argue don't fall for the classic 60-40 trap, but.
Oh gosh. All right, and then we have yes, this is absolutely true. 99.99% of people will be better off focusing on growing income while just buying S&P 500. Very true. And if you try to delve into individual stocks, I recommend first starting small portion of your portfolio, prove to yourself that you are actually capable of beating that market over a longer period of time. And then you can start to, if you figured out a strategy. By the way, there's another thing, Andrew, right? A lot of those people think a long term is like a year. Like, that's ridiculous.
That's when, and I'm much more black pilled on that whole space than you. I'm like, dude, it's a lost cause. Don't even go there. But I have to listen to other talks, their points are like, dude, this fund's outperformed S&P 500 since its inception. And I thought that this was like a few years fund. I pull it up and I'm like, oh, that was November. I was like, wait, we're talking 3 months? I was like, wait, what's going on here? Like,
no, I know it. I had genuinely no idea it was that bad. So, man, well, all right. So I think we've beaten the dead horse. There's probably tons more content to cover the more detailed nuances of these funds. And if I really do want to break down why they're destined to structurally underperform almost perpetually, anything that you really look at as far as, especially when you compare it to the underlying, that's like the layup, for example, it will always underperform the underlying, and therefore its existence is questionable. Its strategy is questionable. And people who need to probably understand this is another thing. All those people genuinely did not understand options until like 5 days ago, or if not even more. And they genuinely think options is somewhat free money, or it's easy money. And I loved when the concept of when you average it out, the two sides of the coin average out to about a net zero rate of return, because the market is generally efficient on the averages. And that's why I say, doing options is actually hard. It's equivalent is difficult to individual stock selection. And then you have to take a very nuanced approach, just like how we preach on Capital Mindset with individual stock selection, with options as well. And in fact, you have to be more careful, not less careful with options. because there's more criteria to consider, because options are going to be time sensitive, and common stock less so. And yes to both here. NASDAQ 100 seems to perform better than S&P 500. Correct me if I'm wrong. This is recency bias. It is anything about the future is unknown. I will tell you that the S&P 500 is more broad, so it's going to capture more return within the United States. And it's going to be self-cleansing. The NASDAQ 100 is the 100 stocks of the NASDAQ. So it's ignoring a bunch of companies where there could be some serious alpha from.
And I'm just trying to see how much is weighted in the top 10 for NASDAQ. That's the other thing.
Yeah.
Like the top, I mean, oh, interesting. Google's not in the NASDAQ.
Nope.
Yeah, Microsoft. Like
if you're listed on the NASDAQ,
oh, no,
you're in. Yeah. The top 100 stocks of the NASDAQ.
Yeah, and I mean, it's very top heavy. I'm just trying to do quick math. I'm seeing like 40, 50% just in the top 10. I could be off on that math, but so Henry Cohn, I like KKR, Carlyle, and Blackstone.
Yep. You're kissing up to Andrew over here. You're just like,
he's my kind of guy.
Yeah, he's your kind. Yeah, he is your kind of guy. Yeah,
just make sure to throw Aries in there too. Aries
Capital too. All right, conclusion. I'll ask you this, Andrew, since you're on here, and actually, I haven't closed the tab or the voting. Actually, you have 5 seconds to get your vote in the poll. Do you think high yield dividends are a good strategy? Yes or no? 5, 4, 3, 2.
Definition of high yield?
Oh, good question. Anything above 10%?
No. No.
1. By the way, I used to think that was high yield, and then people said, "Hold my beer, that's nothing." All right,
how about 100%?
100%. All right, the vast majority of the audience said 72%. I actually don't even know if the 27% are even real, because like Kale was in here and he was like, "Everyone say yes." So this is an unreliable poll, but I imagine some of those people were legitimate and said yes for the right reasons, because they actually do believe it. Okay. So, do you think we're in a clown market, Andrew?
No.
And by the way, Google is in the NASDAQ. 2 classes of stock, so it's lower down.
Yeah, I missed it's number 10 and 11.
No, we're not in a clown market.
No, I could go. There's a lot more nuance to that question, but clown market, no.
Okay. I guess we have to talk about this, because I'm looking at all these like meme coins. That's, I guess, one of the topics we're going to be discussing right now after hours.
Okay. I think crypto is definitely in clown market territory.
Okay.
When I see Joe Biden and like Elizabeth Warren, and dude, if it's not up there, you and me should just make an AOC coin and then we'll retire. But
you want to do it? Let's do it. Like, I'm not against it. Clown market is a spectrum.
No, like I think certain parts of it are very clowny. Like to me, the crypto market, I heard NFTs are back. So to me, it feels like, okay, like NFTs are starting to sell again for millions is what I heard. But like, yeah. I mean, the forward multiple in the .com bubble and the S&P was like 45. We're at like 23. I mean, don't we all remember how insane the clown market? Like if 2020, 2021 is pinnacle clown market, we're nowhere close. You remember how insane some of those were? It's like, I mean, this is definitely, I think, different to that. Now, do I think there's froth? Yeah. I think that if this thing pulled back 5-10%, I'd be like, I think that's healthy. Like, I don't see how some of the stuff that's going on, I think, is kind of crazy. Like some of the valuations I see, I'm just like, that doesn't make a whole lot of sense to me. But I don't think clown market is a fair Like if this is a scale of 1 to 10, I'm calling 2020 like a 10, 2021 a 10. This is like a 6.5 to a 7. Like this is not, I feel like beginning of 23, I was just like, dude, there's so many awesome companies I can buy right now that like, it doesn't make sense how cheap they are. Right now, it's kind of like, oh, can I find something? So that's how I feel.
Yeah. Okay, so this question's actually a good question. And so this is something that you can ask to anyone, at least if they're, making content. I think it's a fair question. So I have already this listed out for club members, posted in the portfolio updates. And the IRR from the channel, so I'll count. See, it's tough to break out the individual entities like by weighting. Especially, I don't want to do that because my personal holdings, I don't want the dollar figure to be known. But for all what everyone knows, it could be $1,000 portfolio. So the holding co, which was started as long as Capital Mindset, or existed as long as Capital Mindset, and is supposed to be the representation of my investment strategy since being public. The IRR, let me actually just go to the posts. The IRR since from February, so because Merrill updates it only by month, and so the entire period since inception, it has been 33.13%, and it started in 2021. On an annualized basis, you break that down by year, has been, so 2021, because it started mid-2021, 8.54%, followed in 2022 for Holding Co., 3.15%, followed by 2023, 66.16%, and then 2024 thus far, 17.82%. Then my personal holdings has a different performance breakdown, and I'll get that percentage-wise, reading it out. So breaking it down by year, and I switched all my assets to Merrill in 2019, so at tail end of 2019. And so I have the data in Merrill going back till that point. And so the tail end of 2019, we barely got any of the capture because it was 2.31%. 2020, 22.91%, 2021, 19.95%, 2022, 16.59%, 2023, 30.65%, 2024, 21.68%. And then cash, so the holding co is never holding any cash. So during down markets, I do expect it to have a little bit more volatility. And that's kind of what we saw in 2022. The 2022 performance, again, when we break down year by year, the performance in the personal holdings was much better, and at a positive 16.59% during the down market, while the holding co still experienced a positive return. But since it was like long equities only, and I was contributing capital in every month, just buying equities, not keeping any cash, the returns were less. Oh, and then the IRR, so the annualized return for the entire period for the personal holdings is 26.47%. And that's including, again, everything mashed together, cash included in there as well. So 26.47%. And then if you want to break it down on a 3-year basis, 27.68% on a 1-year basis. Well, 1 year doesn't matter, but it's 46. And then I do have the other side business account. If this is extra information, you don't really, well, actually, I won't even say that because it's almost like meme tier performance in terms of how good it was. But the other two are more material, and the performance was less than the other account.
Yeah,
I have another YouTuber that's reviewing my entire portfolio. I gave it to them recently. I'll tell you off camera.
Yeah, my annualized returns is not that good, so it's like 18.42%.
Yeah, and I gave this YouTuber who's going to be doing the review all of the performance stuff. So it's gonna be interesting to see. I think they want to have like a live conversation with me about it too, but we'll see. It's a smaller YouTuber. It's not
Okay, never mind.
No, it's not a smaller YouTuber. Okay, and let's see. But by the way, great question from that individual, Luis. And that's something you should be more or less asking most people. And I provide it to club members because club members are club members. So they're basically, I guess, in many ways entitled to that. Right. And it's in a way giving me or showing them my portfolio updates. It's showing them like where I stand. What are my opinions? I reserve the right for my personal holdings to be completely private with the dollar figure, and I will remain that to the end of time. But the holding co, I don't hide the dollar figures, and so that's why I also refrain from doing the weighting. So I just show each of the portfolio performances, and then you can use your imagination in terms of like what the weightings are. But I'm upfront with saying the personal holdings is more material than the holding co, even though the holding co's performance has been better, because a lot of the legacy holdings have actually hindered some performance over some years. And then the holding co has, in terms of like contributions on a time weighted basis to meta, been a little bit better. So, okay. But yeah, that's pretty much the breakdown of it. And I do think, again, most of you watching other content creators out there, it's perfectly within your let's say prerogative, your right prerogative. Shout out to Bacon to ask that. Yeah,
it is within your right, but also I think it's more important to track their performance based on just what they said. Like if you're following a YouTuber, you know, or you're following a community, you know what stocks they're talking about, you know what they've pushed in the past or pushing now, because there are times where you can, I don't want to say manipulate, but I guess we manipulate, but artificially make your returns look better than they are.
Mm-hmm.
So don't also just blindly trust that.
Yep. Yeah, that's why I argue, for example, like time-stamped points of like making videos. You can kind of follow along the ideas of a person and sort of get an idea. What is Tesla? Michael Anthony, you're too funny. What is Tesla? But yeah. Oh, thank you. I impressed Luis. I actually don't have Robinhood. I have a $1,000 immaterial M1 finance account that I run experimental. Right now, my experiment is doing a dividend growth strategy. It's $1,000, but I don't have a Robinhood account. I'm not one of those. Okay.
Yeah.
We have this question that I saw we accidentally ignored, and then we got to move to the private content.
Okay. Thoughts on buying 10-year bonds that yields exceeds the diff yield and stocks? Well, I mean, S&P is like a 1.5% dividend yield right now. So you're asking me if I can get a risk-free 7.5%, would I take it? Depends on where I'm at in life, but I would definitely consider it.
I think if you're young, I think equities only, my man, for a long time, because you're not worried necessarily about the vol of your portfolio.
Someone said risk-free in quotation marks. Nah, I mean 10-year U.S. bond yield is pretty. Unless by bonds he means corporate bonds. I'm assuming that's a treasuries, not.
This comment's better. You hear that, strongman? Strongman's listening while he's doing taxes. You hear that? America over the next 600 years.
Antarctica.
Oh, I read that wrong. Wow, Freudian slip. That means I am bullish the United States over the next 100 years. My brain read America.
No, it's Antarctica.
That is such a. Oh no. Well, now I know how I really feel.
Yeah, I guess they're actually, to be completely fair, massive difference too if you're saying corporate bonds versus U.S. Treasuries when you're saying at 6%.
Yep. And we have the new Yield Max Antarctica Fund, anti.
All right.
All right. With that being said, everyone, hope all of you enjoyed the video today or live stream today. If you enjoyed this and you like the channel, feel free to subscribe. If you enjoyed the video, feel free to comment afterwards. Let us know how we did. If you're on not Instagram, we don't stream on Instagram, but if you're on Twitter, feel free to retweet it if you want. And if you're on Twitch, I do whatever the thing is on Twitch. I don't know what things are on Twitch. But if you're on YouTube, yeah, comment down below. Let us know how we did. Subscribe if you're not subscribed. Like the video if you like the video. Other than that, we'll be seeing you guys on the next one. Hopefully, I have time to get videos out instead of just live streams. But I'll push myself for it. Oh, Michael Anthony. You know what? Because of that comment, what is your question? I will stay behind for your question. Give me your question.
He said, "What is Tesla?" I think we thought he was joking, but he was serious. It's a degenerate stock that pays you out like, I don't know. You go for it.
Oh, I'll say it. I guess by the book. So Tesla is a covered call strategy. It's a synthetic covered call strategy. We won't get into synthetic, non-synthetic, but what you need to know is it's a covered call strategy ETF that tries to generate income from the underlying stock being Tesla. And so you get some mimication of the directional performance of Tesla alongside with some of the income. In practice, it ends up being that you have just about the same, if not more downside, with way less of the upside and a lot more taxable events that you incur along the way, which lowers your overall performance even more. It is effectively a choice that you make by buying it to say, I will guarantee underperformance of Tesla, but I believe in Tesla. And so it is perhaps within the world of finance, among the most less informed decisions an investor can make. And the products are targeted towards an investor base that delves more so on the line of less fortunate than most / well, if you use Andrew's words, it's a little harsher. People who don't want to work. Yeah, so that's kind of the best answer. Why was you talking about that man also?
That was Kemmer. But I would say go back and watch that part. But he's a big proponent of yield max.
We'll just play it again. The reason why I brought that up was sort of like comedic effect. Just this part.
Oh, I don't know how to read this. If you know how to read this, that's great. This is my total value of
Don't laugh.
Don't
laugh. Some people don't know how to read this.
Yeah, but they're not trying to make content telling you how to invest.
That is very offensive, Andrew. I'm very offended now. I'm very offended on behalf of him. All right. Anyways, and I didn't play this video because we didn't have time. But this is another like degenerate video. This is like, let's read the title. Just read the title. I don't need to tell you what this video is about. Just read the title. This is the. I'm not going to get into it. Yeah. We got to get to the private show. Okay. Thank you guys so much for watching. Again, same thing as what I said before. If you liked the content, let us know. Let us know if you didn't like the content, and you can let us know down in the comment section below. I'll try to get back to you. And yeah, if you're curious about the club, we're actually growing now still, but 600 and some odd, 40 some odd club members. So if you're curious about the club, it's in the description below. I guess fair enough to make the announcement here. I'm going to be increasing the price at the end of this month or next month. And so, yeah, that's that. All right.
It'll still be way under what you get elsewhere, though. I'll say that.
Oh, yeah, I'm a bad salesman. It will still be significantly cheaper than probably every other investing club that possibly exists. Yeah. All right. With that being said, thank you guys so much for watching. I'll leave you guys with an outro, and we'll be seeing you guys on the next one. Bye.
Okay. We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.